All-time high on the bank Nifty. Always love the ring of these all-time highs, at least on major indices. So it's a great Monday morning, and it's a brand new high for the bank Nifty. And it's a high which has come when nobody expected it. It's a high which has come at the beginning of the year. Everybody had a flat target for the Sensex. It's come at a time when everybody thought that IT will come back. And there you go. We like to celebrate. And 1, 2, 3. That's the gong. We are celebrating. Our research team all-time high for the bank Nifty. And we like to celebrate milestones. And today is a milestone for the bank Nifty. It's just a number. I don't think this is the end of the rally, so to speak, but yes, after 6 months the bank Nifty has made a new high, and for us that's a moment to celebrate, which is what we do. New landmark for the bank Nifty.
Yeah, and the reason why there could be more legs to this is purely because of what we were just highlighting. The fact that SBI, HDFC Bank, Axis Bank have actually been year-to-date underperformers only gives you more sense on whether or not, if these stocks were to participate, you could see further moves on the Nifty Bank. Right now, of course, most constituents of the Nifty Bank are holding out in the green. Now let's come back to a whole host of other names which are in focus as well. Let's see what Sun Pharma is up to. They're looking to up their stake in Taro. That's another stock in focus, 1.25% lower. Remember, the board has now proposed the non-binding indication of interest for Taro Pharma for the stake. That is. There's also Lupin on the positive, wherein Health Canada has given its nod to market the generic version of Spiriva in Canada now. Lupin starts off 0.5% higher. Oro Pharma came out with its numbers. Q4 is in line. Margins at a 3/4 high. Let's see whether there's any recovery in Oro Pharma or not. That stock will just come up for you on your screens. Whole host of other positive numbers. You've got a ICICI Lombard, which is in focus. ICICI Bank, remember, is looking to up its stake up to 4% in multiple tranches. There's JK Cement, wherein the Q4 is better than expected. Healthy realizations as well. There you go. ICICI Lombard, a big gap up move, 10% higher on ICICI Lombard as we speak. There's of course Dalmia Bharat as well, wherein the Northeast arm has now approved a capex of as sizable as 3,642 crore rupees. So that's pretty big. PFC profits have risen about almost 34%. Ahluwalia contracts, we were talking about these numbers, good numbers there. NCC as well. The margins have expanded to about 9.5%. EBITDA has risen a solid 72.5%. 116 now on NCC as we speak. There's Greenlam Industries, Purvankara, wherein there has been a margin squeeze also, and EBITDA as well has fallen this time around. There's Bharat Bijli, which came out with its numbers. Hudco came out with its numbers. VKUM growth. But the cost of funds have managed to aid the PAT regardless. There's Edelweiss Financials as well, which came out with its numbers. There was VIP Clothing, Walk Hard, all of these stocks reacting to their numbers. And then, of course, there's ONGC, which has, by the way, reported a one-time loss of 9,200 thereabouts. EBITDA as well is lower by about 20% on a sequential basis. 3.6% is the drag that you're seeing on ONGC. There's GMR Airports, Chambal Fertilizers, Karnataka Bank, by the way, the slippages are high and as high as 56%. City Union Bank as well, not such a great performance coming in there. So whole host of these stocks which are in focus on the back of their earnings. But Naresh, I bet you can't take your eyes off from Nifty Bank. Are all the trades this morning that you're punching in within the banking pack?
And how are you feeling about the Nifty Bank hitting that new high?
So that's a good start for a Monday morning. So overall positive on the Bank Nifty, and hopefully I expect much more contribution to come from the rest of the heavyweights which have not done well. So Kotak Mahindra Bank and HDFC Bank would be on radar. Kotak would be the next one to watch out for. A new 52-week high coming in for IndusInd, that looks interesting. The stock which I like right now, continue to like HCLTech. That could be a structural move in the IT pack.
It is not a banking stock, but it is a large cap IT. That's the first trade that Naresh is punching in. What about you, Rudra? Is it all smiles having hit that all-time high on the Nifty Bank Index?
Yeah, definitely Bank Nifty was relatively the outperformer, expected to hit that all-time high sooner than Nifty. And I feel it is just a matter of time. Even Nifty will head towards those levels of 18,850 to 18,900, which can happen this week itself from support of Reliance and even HDFC Bank. Now, when it comes to my stock, which I have to punch now, I feel IT again can do very well from current level. So I am picking Wipro stock, having clearly broken out of those levels of 400, is now headed towards 440, 450 zone. So Wipro looks positive for me, and that will be my stock punch for the day.
Rishabh said joined just now. Let's take a conversation forward and understand from him what he makes of the current market setup. Rishabh, good morning. Thank you for joining us. It's an all-time high on the Bank Nifty. Nifty 400 points away from an all-time high. The tide has turned in favor of Indian equities. Do you think this turn is going to be a long one and we are in for more gains before the year ends?
Because if you look at the economy, I think we've kind of managed the higher interest rates reasonably well, navigated it reasonably well. I think the inflation seems to be peaking out, and hopefully the interest rates also should follow suit. So our sense is that from a standpoint of the markets overall, we think that the economy is in a good shape. Though there is some slowdown, our sense is that it should not be too much to navigate for the company. So overall, we are still positive on the economy.
What gives you the confidence that the worst is behind us? Because frankly, inflation may be down, but globally there are still a lot of concerns, still a lot of moving parts. The war is not over, and you don't know where the next bazooka could be coming from.
There are still globally a lot of moving parts. So I think from a domestic economy standpoint, we are well placed. However, from a global standpoint, there are still, as you rightly said, there are a lot of moving parts. Globally, the developed markets have not seen higher interest rates, and they're still grappling with it. And we don't know how that's going to shape up. So from our perspective, overall, though domestic economy is looking good, however, the geopolitical scene still remains fluid, and we'll have to watch out how it pans out over the next 3 to 6 months.
Last time when we met, your portfolio positioning was centered around Tata Com, Cipla, Tata Motors, Telecom, and Media. Has your portfolio positioning changed? Because a lot has changed in the world in the last 6-8 months.
The portfolio positioning doesn't change so rapidly, Nikunj. We generally, our average holding periods are 5 years. So, our change in positioning is very slow. And therefore, not much has changed since we last spoke. Of course, there would be some granular changes in terms of maybe addition of a couple of names and maybe selling off of 1 or 2 names. But by and large, our positioning doesn't really change very rapidly.
But you were not overweight on banks, and we discussed this briefly. Given that bank is in a leadership sector and banking is where the easy multiplier of the economy is visible, was that a conscious call, or you could revisit your call?
No, our sense is that we think that, we like banks. Clearly banks are in a very good position overall from a structural and cyclical standpoint. However, I think there are opportunities out there which are, according to us, better placed, where businesses will grow faster. And exactly what you said, because the overall macro looks much better. Of course, banks will benefit, but our sense is some of the other companies will grow faster. And that's really why underweight in banks. Underweight in banks is not because we don't like banks, it's more because we like other opportunities better.
Rishabh, hi, morning. Our viewers would be very keen to know what are these other opportunities that you think are more lucrative than banks altogether?
Look, we are looking at bottom-up ideas across sectors. So from our perspective, it is not one particular sector. Of course, as you know, we have healthcare as our largest sector, followed by telecom. But there are ideas in hard infrastructure areas. There are ideas in auto component space. We have companies across a broad range of industries. So we are more bottom-up investors. We take a more longer-term structural view on businesses, and that's exactly how we are positioned. So our positioning is more bottom up in terms of what we like, rather than saying that we are top down in terms of how a particular sector is looking.
Within your existing top 10 portfolio holdings, though, have you added weight anywhere?
Yeah, so we've added weight in some of the auto component companies. We've added weight in some of the infra companies. So from our perspective, we are looking at businesses which we think structurally are well positioned and hopefully will accelerate as we go into economic recovery post the slowdown that we are witnessing right now.
Hi, morning. What's your outlook when it comes to the entire earnings season? Have you spotted any interesting pockets that you believe have outperformed or ones that have underperformed?
Our sense is that Indian companies are navigating the current slowdown reasonably well. So to us, the earnings have surprised us, but for a few segments of the market where, in case of, say, consumer discretionary, we see a clear slowdown in terms of the revenue growth. Similarly, we see a similar thing happening in IT. But by and large, our sense is that overall, the businesses are navigating this very well, and therefore it is visible in terms of the earnings as well in the fourth quarter. So, yeah, overall, I think definitely a positive earnings season for the market.
You had a very differentiated view on media. I mean, I would love to talk stocks, but when it comes to media, I always say, "Bhai, we are a media company. Let's not talk stocks." So, granted. Now, let's understand media. You were of the view that consolidation will happen, which is happening.
Yes, consolidation is happening, which is, I think, going to be a very big driver for the sector overall for the next 3 to 5 years. Our sense is that the structure of the economy also is changing. So, when we go from $2,200 per capita, wherever we are, to say $5,000, our sense is that the spending patterns will shift dramatically, and media will be one of the big beneficiaries of that shift. So we think that it's very interesting that you're seeing consolidation right at the point where hopefully the business will start to see significant inflection in terms of consumer spend. So that's why we really like the space.
Okay. You are overweight pharma. The world is underweight pharma.
Yeah.
Yeah, that's the question. I mean, why are you overweight pharma?
Okay, so from our perspective, we are more liking the domestic pharma side of it. So if you look at our companies, most of them are very strong in the domestic market. We think that the domestic market in pharma or healthcare overall, by and large, is seeing or will see a significant growth and a significant consolidation. So if you look at the top 20 pharma companies in the domestic market, they still control about 40-45% of the market. And that's how when you see IPM numbers, you see the top good quality companies growing faster than the market because they're continuing to gain market share from smaller businesses, so smaller companies. So our sense is pharma is a structural consolidation story. Good companies will continue to grow faster than the market. Market itself is growing at 8-10%. And it's reasonably profitable, generates very strong free cash flows. And we've seen at least the good companies starting to kind of shift their preference over allocating money into developed markets versus, allocating more money in the domestic market versus developed market. So I think we see a structural shift in priority, which is reflected in the quality of balance sheets. And we see a very strong domestic market, which will continue to grow for foreseeable future.
Right. Walk us through the outlook then in terms of how you're looking at the entire consumption space. Because yes, you have spoken about a slowdown in consumer discretionary, but given the fact that as well you have a lot of corporates within the consumption space who have been acknowledging the slowdown, the inflationary pressures, rural concerns, what's your outlook there?
I think overall, there is some, my sense is it's more a tactical slowdown because of higher interest rates. I don't think so there is any structural issue with the demand. The demand will come back maybe in a few quarters. I think more concern in some of the consumer name is the comparative intensity. And I think a lot of segments of consumer space are seeing significantly higher competitive activity with very large players entering the market from various angles. So I think that to me is slightly more structural, longer term concern rather than the demand, which is more tactical and should kind of improve over the next few quarters.
Rishabh, considering your approach is more bottom up, what is looking top heavy right now where you would be at least wary or keep it on your radar other than banks, which you've already highlighted?
No, I think overall our sense is, look, broadly the domestic economy should grow across segments. Our sense is that clearly we don't have too much of a handle on IT because IT is completely driven by what's happening in the developed world, especially US. So that's a space that we don't really have a great handle on right now. And I think, but there are opportunities across other sectors that we see. And where we think that there is a structural opportunity as, hopefully growth picks up as we go into second half of this year, early next year. So we see a lot of opportunities in the domestic space. This is what we like. We are a little concerned on some of these sectors where you are driven by external demand, where we don't know how it's going to pan out.
Okay, fair enough. And what about, in terms of the next trigger going down the line? Do you think that election uncertainty, what we're seeing with the debt ceiling negotiations, etc., could play spoil sport?
There are going to be a lot of moving parts. We have, as you rightly pointed out, we are heading into elections in a year's time, and then there is a lot of geopolitical uncertainty. So we don't know how the next 3-6 months are going to pan out from a overall macro environment standpoint. However, I think we are more bottom up in terms of our stock ideas. We think companies are doing a great job in terms of execution, and our focus is completely on finding ideas across the market cap and segment spectrum, where we think that the businesses are doing well and executing well. So from our perspective, we are much more focused on bottom-up ideas, despite the fact that the overall macro environment will remain fluid for at least some time.
Great to have you on the show. Thank you so much for speaking with us today.
Thank you so much.
Okay, that's the word coming in from Rishabh Sheth. Let's just revisit what the market is up to. Yes, we've already made it to an all-time high on the Nifty Bank, but the Nifty itself as well is not looking bad. We've scaled up a good 121 points higher for the Nifty futures, and now we're touching that 18,700 print on the Nifty futures as we speak. 18,694 is where we're currently at. It's M&M all the way. A good solid 4% move on M&M this morning. SBI Life, Bajaj Finance, HDFC Life and HDFC. It's an interesting mix of names out there which are sitting right at the top. Even the breadth of the market is looking good. So SBI Life, ICICI Pru, Chambal Fertilizers, ICICI GI. It's the insurance and financial plays which are actually bumping up even within the broader end of the market. But Chris Wood does not own IT stocks in his portfolio. That's, him saying that he's unsure about the sector's evolution with the progress of AI. But why does he like Zomato? Here's what he told us.
No, I never have IT, but it's not really my area. But no, there's nothing wrong with the IT company. There's an interesting conceptual argument, which I don't know the answer to, which is how will the IT sector cope with AI? I've got, my base case is I'll be able to manage it, but I've got no inside track on that. Personally, right short term, I would favor staple consumers over discretionary consumers, but this is just tactical.
Have you used ChatGPT to write your free greed and fear index?
I will never use ChatGPT, but I've never used Facebook. It doesn't stop Facebook going up a lot. So ChatGPT is kind of irritating actually, because I was hoping this was, I'm always biased in favor of Asia and emerging markets. So Asia emerging markets were set up to outperform this year if China had come back normally. But this AI story, as soon as ChatGPT happened, is created a narrative for the US tech sector which didn't exist.
The food placed on the table, guess what, has been ordered buys on Zomato.
Yeah.
And Zomato is part of your portfolio. I'm wondering why
I've just added Zomato because I've been under pressure to put that in my portfolio since the IPO, but obviously I didn't. But I think now it's in the long run, this is a very straightforward play on Indian consumption, and the total market cap is very small relative to the potential addressable market. And based on what I've been told, only 6% of the Indian population apparently currently pay for things digitally.
So,
e-commerce.
Chris, there are a couple of last follow-up questions, and I promise I'll not extend our appointment beyond that. Last 12 to 18 months, we've been in a cycle of interest rate hike globally and locally, and typically when that happens, hard assets do well. Growth stocks, they underperform. Now perhaps we could be in reverse of that. So do you think globally growth stocks could make a comeback? Guess what? I mean, you've got Nvidia, which has already become $1 trillion company.
No, but Nvidia is different, you see. So I put Nvidia in my global portfolio when I realized this GB chat story, because in this, we don't know which form of AI will really take off. So what you want to try and own is the picks and shovels of AI. And apparently it seems to be the case that people need Nvidia's GPUs to do AI. So that explains why. And basically, the tech sector, I was just saying, now has a new story, because first quarter people were buying all the semiconductor stocks before on the argument that the demand's recovering, but actually all the demand estimates for PCs, smartphones, and regular servers are still going down. So this whole GB chat has just created a new narrative, and you have a spectre of unlimited growth. So that gives a story back to the tech sector.
It's May 2023, but hypothetically, if I take the clock forward to May 2028, and we are having the same chart ordered on the Zomato, and I still have the Greed and Fear newsletter in my hand, what do you think potentially 5 years from now we could be discussing?
5 years from now, we'll be discussing, we might be concerned that the banks and property cycle is peaking.
Okay.
But then the other key issue was whether all this promise of made in India has actually become a reality, because the production will either be moved to India or it won't have been. At the moment, this is very early days, but there's promising signs. And then the other question is just this whole, tax revenues growing as a percentage of GDP, and the whole economy becoming more formalized. Has there been more progress on that front?
All right, that's Chris Wood spilling the beans and sharing with us his outlook on the markets. But 18,616 on the index, while pharma energy is taking a backseat. The Nifty Bank is doing wonders. You've got metals as well supportive. IT as a basket as well is holding out quite comfortably. And within the broader market as well, there's a little bit of a lackluster move as compared to the frontliners. Names like Balkrishna, City Union Bank, something like an Aurobindo Pharma, as well as Moil and ONGC are under pressure, while ICICI Lombard scales up a solid 11%. ICICI Pru notches up. NCC is looking active. M&M, SBI Life, along with something like Karur Vysya Bank, they're all abuzz in trade. But let's hear it out then from Prashant Jain as well, Director 3P Investment Managers. He sees a further scope for re-rating within the power sector. Where is it that he sees value? Listen in.
So I think one space which has also got re-rated, but I think there could be still some scope for it to get re-rated is the power sector. Because go back 2 years and ESG was a very live theme, and the world thought that you can transition from conventional to new energy overnight. And we have discussed this number of time, that was not a very realistic view. But I think people have come around to that view, that conventional power is here to stay, and world over you are seeing what is happening in the power space. Even in India, it is now possible shortages of coal or power that make the headlines. And recently I think there were some reports that we are likely to announce fairly large.
Pankaj Mittal, Chief Operating Officer, and Kunal Minali, CFO with SAMIL, they both join us. Good morning, gentlemen. Thank you for joining us. Kunal, so on quarter-on-quarter basis, your EBITDA margins have expanded. Is it largely because of the lower energy costs, or were you able to take on a price hike? Can we expect similar kind of a margin run rate for FY24, or is there some more room for expansion?
Right. So first of all, we are very pleased with the results. The results are done at a time when inflation is at an all-time high. So against that backdrop, we have still been able to deliver it, and that's a lot thanks to our customers, who's supported us, where we have shared some of the pain of these inflationary costs. Our teams have also worked very hard in order to improve many of our operations. There were red units, which we are working hard to turn them more and more profitable. And at the same time, from our location and product mix perspective, we've been favorably positioned. Both Europe and North America has grown this quarter. And with our product mix being more tuned towards EVs, a lot of content has also flowed in. So, a lot of hard work with industry tailwinds have helped us deliver these results together with customer support.
Kunal, order wins of about 2.8 billion euros in the second half. That, I guess, is lower to what you've clocked in the first half. Is the demand environment improving globally?
First of all, I think you're referring to SMRP BV order book, possibly. From Samuel's perspective, this is the first time we have released our book business, which is at an aggregate level, nearly 5.7 lakh crores or $70 billion. That, if you think about, will get executed over the next 5 to 6 years, gives you a good spread of how our growth is at least expected from the current order book. Also, needless to say, there's a lot of pressure across the industry still, and that means some of the more people who have better balance sheet strength tend to get the disproportionate share of orders. And that's what we have seen actually in the last few quarters, and we expect to see that going forward as well. So in our view, we are very well positioned for growth going forward.
Pankaj, on your European operations, from a revenue run rate perspective, are we closer to the normalized run rate, or are there still supply chain pressures?
See, we see our customers doing better, but if we look at it from the pre-COVID times, still the volumes are lower than the pre-COVID time. However, the improvement is continuing.
Kunal, 1,000 crore quarter-on-quarter debt reduction, lowest debt and leverage in last 7 quarters. How much further can we expect to go down on this?
Right. So I think, as we have mentioned, our organic business continues to move from strength to strength. In fact, we were expecting, frankly, a lot more deleveraging to happen with more reduction in working capital. However, that remains work in progress. But that also means that going ahead, we should be able to further delever our business. That is as regards the organic side. Going forward, we would also be, there are announced M&As that have been done or acquisitions that have already been announced. These will require some amount of debt to also come in. So at an aggregate level, after the announced acquisitions, we should still be sub 2 times debt to EBITDA.
Right.
Kunal, the SS acquisition is on track to complete by Q2. Any delays or any other timeline completions which could delay this entire integration process?
The acquisition, right now at least it seems we should be there by Q2. The integration is an ongoing process. It's a large asset. Will take some time to integrate, and we've created our own integration teams and working towards it right now. Time frame unknown. Once we get it is how we will come to know, and we'll spend more time around it.
Right. Kunal, your strategic acquisitions in FY23. Any more acquisitions that you may have lined up for this fiscal? And EV being a forefront, are you looking to acquire companies that have more share of EV in their books?
The direction is not EVs for sure. Having said so, I think acquisition is a bread and butter part of Motherson. There is a large pipeline of M&A targets that we continuously look at. And in an environment which is as foggy as what it is, the reality is the customers are also looking at stronger houses to house some of the more painful assets for them, where we stand to be looked at positively given our own balance sheet strength. So yes, M&A will be a regular feature, hopefully in the ensuing year as well.
And Pankaj, 20% of the order book is from EV. So how do you see this pie increasing in FY24?
It will all depend on the makers. So we, as a OEM supplier, the car makers, as you see them in the market, the demand for EVs has been there, and slowly and steadily they're gaining ground. So it will take time before there is a very big percentage of EV cars in the market. But having said so, we have very good order book from the EVs, which shows that all the technologies which are required by the new gen cars, they're all there with us. And we are working hand in hand with them, both with the established players as well as the new gen players.
Kunal, so far FY23, broadly your revenue was around $10 billion. Your 2025 target stands at $36 billion, which is 4x in the next 2.5 years. How confident are you achieving that target?
So, look, I think the 9.5 billion is what is there today, and then there are announced transactions. The announced transactions are actually adding nearly 5 billion on a gross basis to the top line. In addition, we've given you the order book of 70 odd billion for 5 to 6 years, which should further, expand the 9.5 going forward. So, give or take, we are nearly halfway there. And as I said, there's a large pipeline of M&As that are still there, which we'll see how it plays out. But yes, I think we are fairly confident that doing the 36 is the easy piece. The 40% ROC is frankly the more difficult piece, but we'll work hard towards it.
Right. Kunal, Sumitomo Wiring did reduce its stake in Samvardhana Motherson, right, to about 14.3 in the fourth quarter. Can there be more overhang from investors' point of view of a further stake sale, or they plan to stay committed?
I'd mentioned this earlier as well. I think these are conversations which are best done with the shareholder. From a company perspective, Sumitomo remains a strong partner. Nothing has changed at the partnership level or their involvement in the business. They remain on the board of SAMIL as well. So from our perspective, it is status quo. Rest, I think it's their shareholding, so it's best asked to them.
All right, gentlemen, thank you so much for taking time out and joining in and giving us a view on how business is shaping up, as well as the outlook on Samvardhana Motherson.
All right, now it gives me great pleasure to bring on board Dr. Anisha, Managing Director and CEO of Mahindra & Mahindra Group. Now, bear in mind, Mahindra & Mahindra is one of those performing stocks in last 12 months. Everyone's happy, shareholders, management, employees, even car owners are very happy because XUV 700 really has been a delight. Even tractor owners are very happy because margins are strong, sales are doing very well. Everybody is happy, Mr. Shah.
Nikunj, thank you for the fantastic introduction. Yes, you're right. We are happy right now. We still think there's a lot more to do, and we are very well positioned with the growth we've driven so far.
What is that lot more which needs to be done? The repair work has started, subsidiaries are firing full cylinders, the domination in the tractor industry is intact, and SUV is doing very well. So what is the lot more?
Yeah, so Nikunj, you're right. First, let me just focus on what has been done. So we've clocked greater than 10,000 crores in profit. And that actually is a combination of auto, farm, and what we call services as well, because services has actually made up half our total profits, and that has been growing very well. We are number one in SUVs now. Our market share has grown from 13% to 19%. Number one in tractors by far. Number one in LCVs, less than 3.5 tons. Number one in electric three-wheelers. So from a market presence standpoint, that has worked very well. We've got a great suite of products. Our bookings continue to be very strong and much higher than, in fact, what we can produce right now. So our production is being doubled, and that will soon catch up and hopefully we bring our wait times down. So from all perspectives, we are firing on all the cylinders. Now, a lot more to be done is to be able to get global leadership because we've got leadership in India in auto, and that's something that we've got to now take across the world to be able to do a lot more with our growth gems. And they've been doing well, but we've just put a 5x challenge on growth gems to be able to grow 5x in the next 5 to 7 years. We have the ability to do so, and therefore that's something we're pushing for. So that's the next step for us. And again, we feel very good about where we are right now. Our teams have done a fantastic job, and I would give them a lot of credit. But we are not resting at this point.
You know, that's a very interesting point, Anish, that you made. Morning, firstly. Wanted to understand whether you've drawn anything constructive on the paper for your global foray, because, you know, you have a very large auto portfolio. So I'm wondering what within that would make it to the global shores.
So we have drawn out a plan, and it is going to be phase-wise. Our approach is whatever we do it really well. And therefore, phase one will be in markets that we have a reasonable presence today, markets like Chile, South Africa, Australia, and there we're going to go with the XUV 700, the Scorpio N. We may have a wider range of products as well. And beyond that, we will look at other markets. But first, we want to try to get to a very solid market share in these places before we expand further globally in the next phase.
I'll be very specific here in terms of understanding the re-rating moment for Mahindra & Mahindra, and it was the SUV dominance. Dominance is the real word there. Market share gain, new launches. Now, when we spoke to you last, you were excited about the way the order booking was moving. But what markets would like to know is that have the semiconductor issues been sorted, and are you likely to really clear up a lot of backlog, which really could give a lot of delta to your business this year?
So Nikunj, on that, semiconductor issues have largely been sorted, but they're not completely gone. So we still see an impact of about 10 to 12% every month with regard to something not working well on semiconductors. Our capacity has gone up from roughly 24,000 to 39,000 now, and that will go up to 49,000 units a month. And that will help us start bringing down the wait times that we'd like to. We, however, continue to see very strong demands across all our brands. And that is, again, a very positive sign. But as that continues, we will continue to increase capacity.
To you last time, you said, look, we are also rebooting our subsidiaries, and some of them have been rebooted. But there are two subsidiaries specifically where two businesses specifically where we see a lot of volatility. The IT business, which is Tech Mahindra, and the finance business, which is Mahindra & Mahindra Finance. Could this year be the repair year for both those businesses?
So on Mahindra Finance, Nikunj, we've started a turnaround, and I would say the business has done really well. If you look at our gross NPAs or stage 3, it is down now to less than 6%. And this was as high as 16% at one point in time. But more importantly, there's a very strong focus on asset quality. And that focus will ensure that we don't go higher even in a further economic downturn. The net NPAs are 2.5%. So the asset quality is extremely strong. Disbursements were up 80% in the year. Assets under management were up 27%. So that business is on a very strong footing right now. I would still say it's halfway through its turnaround. There's more work to be done on that front, but it's on a very solid trajectory. Tech Mahindra has had some very strong positives in terms of large account wins and its customer centricity. There's a little more work, or in fact, a lot more work to be done on margins, because in margins, we are lower than the industry, and we are targeting in the short to medium term a 300 basis point increase in margins, which will help get Tech M back on a very strong footing.
So broadly speaking, the ROE strategy of 18% on an aggregate basis, do you think for FY24 that is going to be the focus mantra?
Nikunj, on that, we actually delivered 20% this year. So from an ROE standpoint, we are well ahead of what we had committed. In fact, we had committed to 18% in about 5-year time frame. We got there in 18 months, and we will stay firm with that. Where our businesses are working right now, we don't see any issues in maintaining greater than 18%. What we have told our analysts and investors is we are not going to increase ROE, but we're going to increase growth because we want to grow in a much bigger way. So on the ROE front, expect it to sort of vacillate between 17 and 20% over the next few years. And that will be a function of the investments we make and the time it takes to get the growth from our investments. But our focus right now is really growing all our businesses.
Take the clock back, Dr. Shah. We've seen a transformational growth in your auto business. We've seen an incremental growth in your tractor business. And we've seen a strong comeback, let's say, in Mahindra Finance and Mahindra Holidays. Which are the companies which for FY24 are at a transformational growth and which are the companies which are at an incremental growth?
So I would look at auto continuing its transformational journey, especially as we look at international. On farm, there are a couple of areas for transformation. One is farm machinery, which is something we are targeting at 10x growth, as well as international. Mahindra Finance will continue transformation, TechM will as well. And beyond that, each of our growth gems, as I mentioned earlier, has a 5x plan. Sustain, a solar business, has already signed up for the 5x plan, and we have IFC as an investor who's underwritten that plan already. Our last mile mobility business got a valuation recently of $730 million from IFC. From IFC as it came in. Sorry, Sustain was Ontario teachers who had come in. IFC came into last mile mobility, and they've got a 5x plan that's laid out as well. And for each of our other businesses, we are there or almost there in terms of outlining that plan. And that's going to be a transformation across our businesses. So as I said, Mahindra is not just an auto business or a farm business. We also represent services across the breadth of all of the industries in India, and therefore are very well positioned with the India growth story.
But I wanted to, delve a little bit about what your reading is of the rural end of the economy, because, that is a large part of your revenue pie, at least when it comes to autos. Because not just government spending ahead of elections, but the other big factor is also going to be El Nino. And from what we understand is that El Nino years typically have an 8% impact on growth. What is your reading right now?
So we've gone and looked at El Nino over the last 50 years, and what we've seen is that from a tractor industry standpoint, there's really no correlation between El Nino and tractor sales. But that said, from an auto standpoint, we've got a lot more urban customers now. So there's a lot less dependence on rural. And there are a number of other factors that have been driving rural demand as well. And that is an increased focus on mechanization. Farm incomes have been better, and that's something that we see continuing to go forward. So we may see some years being a little slower in terms of overall growth for the farm business in particular. And this year we would expect a single-digit growth, for example. But on balance, the farm business is very well poised, and the other growth drivers will really help us take this business forward.
As a business, and I'm talking about the Mahindra Group here, which of your businesses will have the bazooka moment in FY24? I think to my mind, the previous fiscal was all about all that you did with your SUVs. What's going to be the leader for FY24?
I would look at financial services as being a leader for FY24. I would look at auto as continuing to drive strong momentum. And I would look for some of our growth gems as we saw Sustain and Last Mile Mobility come up as strong companies in F23. I'd expect one or two of our growth gems to come up as strong in F24, potentially with outside investors coming in.
Be looking at another large incremental top-up deal in the Mahindra Electric business in FY24?
Because we actually have been very focused on growth with the capital that we have ourselves. BII came in as an investor because they were very keen to look at electric, and we felt that as a marquee investor, they could add a lot of value for us. We have not actively been looking for more funding in electric. We can fund it ourselves. But we do have an outreach from a number of global funds with a very strong interest in this space. So if there is a matching of minds, and if we do feel that someone can add value, then we may bring them on as an investor. But at this point in time, we've got 14,000 crores on the balance sheet. We've got a very strong cash generation across the businesses, and therefore we're not actively looking for funds.
I'm going to just talk about the macro setup for FY23 and then let's say get your outlook for FY24. FY23 was tough year for the entire auto industry. Margins were under pressure, commodity prices were higher, interest rates were moving against the consumer. All that will normalize in FY24. If that normalizes, what happens to you?
We show higher margins and we continue even faster on our growth trajectory.
Can I assume that the ROE, which you've already at 20%, should actually stay above 20%? Because if you're talking about high growth, higher margins, and you want to be investing sensibly, that means logically and mathematically, ROE should be going higher.
So, Nikunj, we are very careful in our commitments. So, our commitment continues to be at 18% because what we will see is as we invest, there's normally a short term impact in that investment over time. Yes, it will be higher. But in the short run, we may decide to invest more in certain areas, and therefore we will stay with an 18% commitment on ROE.
Conservative here? Are you downplaying your optimism? Why do I get that sense?
My optimism, Nikunj, is on growth because we want to grow our businesses multifold right now. And in terms of our investors as well, the discussion we have with them is, tell us if you want more ROE at the expense of growth. And their response always is, go for growth. 18% is a great number to have for ROE.
Every subsidiary has a different cycle, and the growth numbers for auto would be different. The growth numbers for financials would be different. It would be different for IT. How do you define growth for the Mahindra Group this year?
How we define growth is for auto. Let me take that separately because you're right. Each business is going to have a separate cycle for growth. For auto right now, it's about ensuring that we can enhance capacity rapidly and be able to deliver on our commitments in terms of delivery of vehicles in India. Second is taking leadership in electric vehicles. And we're going to come out with 5 SUVs that are born electric next year. And that's a very big step forward. And the team is focused on it and on track at this point in time. And third is global leadership for auto. So those are the 3 key drivers for growth on the auto side. On the farm side, it's maintaining the strong market share. We have 40% plus in India. We've in fact grown that over the last couple of years as well. It's also looking at farm machinery and global growth. In Mahindra Finance, it's maintaining a strong asset quality, diversifying into a few other businesses. In Tech Mahindra, it's about margins. And for each of our growth gems, they're very well positioned in their industries. Take holidays, for example. We are the best in delivering holidays for families in India. And that's something that has huge demand. And for us to be able to do that 5x or 10x should not be difficult. Similarly with logistics, our business is very well placed, has a number of services that span across the logistics industry. And we should be able to do a lot more. Same with real estate, same with our solar business. So there are multiple growth levers that we have across each of those businesses. And because those are mid-sized businesses, that's where we're really looking at 5x. Because 15 to 20% growth is easy. We've done that. But that's not what we would aspire for.
Right. Anish, I'm curious to know which of the M&M cars are you driving?
The XUV 700, though I continue to drive some of the others from time to time as well. And I frankly love all of them. This is something that our consumers tell us. So obviously I'm going to be biased. But the cars that we've delivered over the last 2 years or 3 years have been a quantum jump over the industry. And that's what we're seeing in all the booking numbers.
I was wanting to ask you this question, but never late than, never. Better late than never. If for some reason the Mahindra car is not available, what would be your next port of call?
I would wait for a Mahindra car, as a lot of our consumers unfortunately right now.
But there is a waiting period, sir, in Mahindra cars.
That's the other thing I wanted to ask. Has the waiting period on XUV 700 decreased or not?
You're letting me go, but there's a waiting period. Let's first understand. Okay, if the waiting period for Mahindra car is long, what will you do? It's an emergency, you have to travel. You'll have to travel.
I would look for getting a Mahindra card from a friend or renting one. Stay with the Mahindra card.
Smart one. Okay, Anish, we'll let you go on that note. Good chatting with you as always.
Yeah, same here. Thank you. Bye.